Good morning, mortgage coaches. Thanks for joining us for the weekly Thursday training call. Today, I think we're going to go over just a couple of fields that we've been noticing we're getting a lot of requests for in the support box, and I'm going to go over the reserves as well, just so everybody understands how those are used and how they funnel back to your closing cost details. But I hope to be able to show you just a couple of the gotchas in the system today that you want to make sure that you're aware of, so that when you finish your report, you're pleased with the accuracy, and you can hunt down any issues that you may be running into. So I think for the first thing here is we're going to start with a brand new client, and this is probably one of the #1 questions we get coming through the support box. So I'll make this a purchase client. Oops, got to spell that right. And by the way, while I'm doing this, if you guys do have questions that you'd like addressed, please type them into the questions area in the GoToMeeting toolbar. I'll be watching that on my second screen here, and as I see those come in, I will try and address those for you. But let's get back to our purchase scenario. Now, one question I get constantly is, I'm doing a purchase, and my borrower, he doesn't own a property, but I don't want to do a rent versus own. So what do? Do I select own, or do I select rent here? And what I would tell you is, when you select rent, Edge is going to try and guide you through the rent versus own. Now, with that said, what that means is that if you select rent right here and you go to the analysis screen, you're going to see the rent analysis summary. Now, this is going to display what's going to come out on the rent versus own. Now, as some of you may know, when you get to the presentation screen, you still have the option to choose a total cost analysis. So you can do one either way, no matter what you select on that first screen. But if you do select rent on that first screen, your analysis button is going to reflect rent versus own. So the question then becomes, how do I make it reflect what the total cost is going to show? The quick answer on this one is select own. Even if they don't own a property, it's okay to select own, because you're actually going to defeat that home ownership question by selecting the appropriate goal in the following screen. So I will go ahead and hit the right arrow button. And what I'm going to do is I'm going to select purchase a new home. But before I do that, I want to show you what this looks like. Just if I was to go and prepare a preview of this total cost analysis right now, I want to show you what appears on it. So without selecting that purchase goal, you can see that I'm showing a current mortgage and a new product. Now obviously, if this is a purchase, I don't want to show a current mortgage. I certainly don't need it there. So I can get rid of that one of two ways. I can either uncheck the box next to current mortgage when I get to the presentation screen, or the easy way is make sure you select the purchase goal. When you select the purchase goal, this actually removes the current mortgage from the presentation and removes a lot of the questions about current mortgages. So as soon as I hit this right arrow, we'll jump over to our analysis, and you can see that it has removed the current mortgage from the presentation. So this will be just purchases. So 2 points there. The first one is, in the client screen, if my client doesn't own a home yet, but I still want to do a purchase total cost analysis, the best method is to choose own, even though they don't own a property. Then in the next screen, choose the purchase goal. This will eliminate the current mortgage from the presentation, and it'll ensure that all your new products are showing. All right, so that's one thing that has been coming across quite often lately. The other method I described for you, where you can uncheck the current mortgage box, had I left that purchase goal off, we'd actually see current as one of the products here, and we could deselect it by simply unchecking the box. That is a perfectly effective way to do it as well. But one of the reasons I wanted to point out that that goal and selecting own in the first screen is, when I go to the analysis screen now, you can see that this is a total cost analysis look instead of the rent versus own look. So if you're wondering how to get back to the appropriate look in the analysis summary screen, check out your Clients tab here and just select Own, and then select that purchase goal, and you should be good to go. All right, so the other thing I wanted to talk about today is cash to close. Cash to close is probably the #1 question that I get coming through the support box right now, and sometimes it's centered on, why is my cash to close a little bit off? Sometimes it's, why am I not showing a cash to close at all? Other times, it's I've entered specific data. It's supposed to match my sheet here, but it doesn't seem to be matching. So what's the problem? And I will tell you that when those come across our desk, usually, we're going to ask you for the link to your presentation, but we're also going to ask you for your fee worksheet, because we want to know where you're getting the cash to close that you anticipate is supposed to be there versus what Edge is showing. Now, as you can imagine, having to hunt through that paperwork and try and match it up with your file, it does take a little bit of time. So I want to show you a couple of quick methods to help you solve that problem if you do run into a cash to close issue. So I've selected own here, and this one's actually going to be a refinance transaction. And the reason I want to show you a refinance transaction is because there's going to be a payoff versus just having down payment plus any closing costs that are not financed in. So we'll start with selecting own. I'm going to put my friendly name as refi for primary. And for those of you who are brand new to the system, the friendly name here, this is not a nickname for your client. This is actually a nickname for your presentation. So this is going to help you identify what this presentation is, especially if you're doing multiples for a single borrower. Say, for instance, you're doing one for the primary residence and then another one for an investment property. This is going to help you identify what this is. I'll show you what I mean if we go back to our home screen. If we hit our View All tab here, and I go and look up that client I just added, that's new purchase. And hopefully I only have one of them in here. Yes, I do. You'll notice that when I hit the drop down, the friendly name shows right next to the date and time stamp. If I don't have a friendly name, that refi for primary part there won't even show up. So all you would see is a date and time stamp. It's really hard to identify what that presentation is. All right, so let's get back into it. Now the second screen here is going to be goals. So we're doing a refinance transaction today, so I am going to deselect the purchase a new home goal because I do want to be asked about the current mortgage. And instead I'm going to choose one of the other goals, like maybe lower my interest rate. And Betsy has a question in the box. She says, would you use the hazard insurance reserves box for a refi? Absolutely. So here's how you would do this. When we get to our product screen, I'm going to show you what that reserves field does and how it pipes back over there. Now we've selected lower interest rate for our goal, so this is going to guide us through a refinance transaction. Now this screen is where people get hung up on the most. Now you'll notice that there's only one field here that's actually in red, and that means that if you don't fill out this field, you're going to get an exclamation point down at the bottom. As you can see in my products area, I've got an exclamation point because there's a couple of fields that are in red on my product that are not filled in yet. Now for this one, there's a couple of things that you need to be aware of. One is that this top field, the current monthly mortgage payment, this is just asking you what your client says they're paying. This is not going to show up on your presentation. The actual mortgage payment for the current mortgage is going to be calculated based on the info that you put inside the following screen, which is going to be things like the original start date, the original loan amount, the rate, and the term. And then, of course, if it's interest only, the current balance. Now, with that said, this field, as I said, it's not going to show up anywhere on the presentation. It's a data collection point for you to ask your client, what are you paying right now for your mortgage? Now, I get a lot of questions about this. Am I supposed to be asking for a P&I payment? Am I supposed to be asking for a PITI payment? It doesn't really matter. What you're looking for is you're just looking to find out what the client thinks they're paying. What do they perceive as their mortgage payment? Now, that may or may not include mortgage insurance. It may or may not include taxes and insurance, maybe an HOA. There could be other parts of this payment that they're not disclosing. And what's going to happen is when you get to the next screen, you're going to have an area where you can ask them all those questions. So for today, I'm going to say the client said they're paying $2,500 for their mortgage payment. And I don't know if this is P&I, PITI, I don't know if it's P&I and MI, but we'll find out. Now the next step here is we need to do the required field. This is the property value that's going to be assigned to the current mortgage. So let's say that their property value is $300,000. Now the next field here is very important for loans that have MI. If you have a borrower with a current mortgage with mortgage insurance, the mortgage insurance is based off the original appraised value or purchase price, not on the current appraised value, because unless they were to do a refi, or unless they were to do a new appraisal, that new value isn't technically attributed to the property, so they couldn't appeal to drop MI. So that being said, this field will become very important when you're using MI because you want to make sure that your LTV cutoffs are based on the correct purchase price or value. So let's say that when they originally took out this loan, it was for the value was at $275. So it's appreciated. It's gone up to $300,000. But I want my MI to be based on this original appraised value versus the current appraised value. Now the next field here, this one you do not have to fill in if you don't want to. We put this here as a convenience for you. Now normally when you're doing a refinance transaction, in order to generate what the payoff is, so we can pay off what the current mortgage is, Edge usually just looks at the current loan amount and says, okay, that's the current loan amount, that's what we need to pay off the current loan. However, these transactions sometimes can take time. The current loan amount may be less by the time they close. They may have made an additional payment. It may be more if they have extra, something that they need to pay on top of the regular mortgage payoff. But that comes when you look at the payoff demand statement. Now, if you do use this field, if you do use the current total payoff amount field, this is going to be used for the cash to close calculation. So it's going to apply that new loan against whatever you put in the payoff field here, and the difference will either be cash out or cash to close. So I'm not going to put in a payoff amount field here just yet because I don't have any real details for this loan. But I am going to come back to this and show you what the potential pitfalls of using this field are versus the potential benefits for using this field. Now as we go forward, now we get to the part where we ask about the pertinent questions about their current mortgage. This is going to generate the payment inside Edge. So if I'm on the phone with my client, or in fact if I've gotten this off a lead sheet of some kind, I may or may not have all the information. My client may or may not have all the information. It's okay to come back to this. Don't worry about it too much. So for instance, you can use ballpark dates. You don't have to know the exact date of the first payment. My client told me, hey, I got this loan 3 years ago, and I'm pretty sure it was around the beginning of the year. Okay, so I'm looking right around January of 2011. So I'm going to go to 2011, and then I'm going to go to January. And I'll just select the first. Now the original loan amount, you can get this either off the credit statement if you've run credit already, or if you haven't, this should be something your client would know. What was the total amount financed when you originally took out the loan? They can also look at their mortgage statement to find that out as well. But let's say they took this out at $250, and the interest rate they got on this 3 years ago, let's say it was about 5%, and this was a 30-year term. Now, as you can see, when you go through these fields, Edge automatically calculates what the remaining balance would be if they just made the regularly scheduled amortized payments. Now, if they've made additional payments to principal, or God forbid they've missed a payment for some reason, their remaining balance might be different. It would be different from what the amortization would calculate because they've done something to offset it, either positively or negatively. So for today's case study, I'm going to say that they actually made a couple of extra principal payments on this one. And rather than owing $236.2 right now, they actually only owe $234. So I'm going to type $234, and that is my new remaining balance. So if I do not use that payoff amount field that we looked at earlier, this remaining balance field is what's going to be used to calculate my payoff on my new refi. Now it's important to note what this auto update balance does. If you check this box, what this does is this means that if you come back to this presentation a couple of months down the line, the remaining balance will automatically update based on today's date. Now I will tell you, you should only use this when you know they're making the regularly scheduled payments. If they've made additional payments, it's not going to know where they are in the amortization schedule. So in a case like that, don't check the auto update balance box. However, if you know they're making just the regular payments, feel free to check this, and you can see it put back in my $236.2 there because that's what they would have paid had they made just all the regular payments. Now if I come back to this particular loan product, or if I come back to this presentation 3 months down the line, this remaining balance is going to be reduced by 3 months of payments. Now for today, remember, we're going to say that they made additional payments, so $234 is actually my remaining balance. Now if this was an ARM, I would select ARM here. For today's study, I'm going to do just a fixed loan so we can kind of get to the cash to close part of this. If it did have an interest-only period, you'd want to indicate how many months from the start date the interest-only period is. So for instance, if this was a 10-year IO product, this would be 120 months. Now balloon payments are normally used specifically for seconds. Usually you've got a 30 due in 15, which means that you've got a payment that's amortized as a 30-year payment, but it's due at the 15-year point. So by the time that month 180 comes around, whatever's left, whatever principal remaining balance is there, they have to pay it in full. So just keep that in mind. You're only going to use this on seconds. I don't think I've ever seen it used on a first, but we leave it here just in case loan options change in the future. Now the bottom part here, the P&I payment, this is calculated based on the variables you put up here. So this is a great way to check if you've got your information right. And you can see that for this particular study, I mean, if I'm looking at a $250,000 loan at 5% over 30 years, this is going to be my principal and interest payment. If this was interest only, so let's put those 120 in there. You can see that it reduces it. This is actually an IO payment. It's not going to change the label for you right here. It's still going to look like a P&I payment. However, this is in fact interest only. No principal is being applied with this payment. I'm going to change it back to fully amortized. And then now it's time for our monthly costs. So if you probably will know dollar figures for these, and that's on a refinance transaction, you probably have exact figures because you've got either a mortgage statement or they've told you what they're paying. So let's say they're paying about $80 for hazard insurance and then $250 for property tax. Now mortgage insurance, this is where that appraised value field comes into play. Now right now, if we were to go to our products, you can see that my current LTV is 78%. I am right on the cutoff line for MI, and that's based on my current property value. So let's go back to our assumptions real quick. That 78% is based on this $300,000. However, the MI calculation is going to be based on this $275. So if I input MI with a 78% cutoff, it's going against this $275, which means it's going to show. So let's put some MI in there. Let's say this was about 0.9. And we're just going to leave the 78% cutoff. We don't need to check the Calc MI on balance box. That's only for government loans. And then we don't need an MI cutoff month. This really should be minimum MI month. So for instance, the old FHA loans where they had to carry it for a minimum of 5 years, then if they were at 78% loan to value, the MI could drop. That's what this field is really for. It's also for today's FHA loans where it has to go for the entire life of the loan. In that case, you'd put a 360 in here. So you would indicate that it can't drop at the LTV cutoff at all. It has to go for the life of the loan. All right, so back to it. This is conventional. We're using a 78% cutoff, and it's against that 275 value. So when we go through, if we were to look at our products now, this payment here does include MI. Now, if I was to go and remove that original appraised value line and allow it to just use current value, that LTV is going to be based on current property value, which is not correct. It's going to strip the MI out of this payment because it thinks it's past the cutoff point. So that's a question that comes through quite often. I've entered MI in my current mortgage and it's not showing up in the payment. Why is this happening? I can see that my LTV is right at the point. It should still be applying. In reality, it needs to be based off that original appraised value. So make sure that if you find that you're entering MI for a product, you know it's supposed to be there, but it's not showing up in your presentation, 10 to 1, you're below your LTV cutoff on the regular appraised value. So you need to make sure and enter the original appraised value so it can base it on the correct figure. All right, so back to our data entry here on the current mortgage. I finished my monthly costs, so now I'm going to the affordability section. And again, none of this is required. This is so you can give them a full financial plan if you want to. If you want to actually eyeball what their DTI, what their total debt ratios are, in fact. If you want to eyeball what they have in their savings account and start earmarking some investments for growth, you can do that as well. Now the bottom part here, tax bracket. If you do enter a tax bracket in here, your reports are going to show a tax benefit. If you do not enter a tax bracket, there will be no tax benefit line on your presentations. So just keep this in mind. That tax benefit does factor into calculations for the short-term area. So if you're a little confused about how that short-term is, we're going to explain that when we go through to the end of this presentation today. Now I am going to input a tax bracket because I want to show you what that tax benefit is going to look like. Oh, by the way, if you don't know your client's tax bracket, you can always hit Find Tax Bracket, and this is going to guide you through a few questions about their income and filing status, and then it's going to show you basically a grid that allows you to identify exactly what bracket they're in. Minimums and maximums, I'm not going to worry about this for a refi. The only thing here that would be pertinent to my refinance would be possibly cash out, but again, this is another question area where you're trying to gauge what your client is trying to do, kind of along the lines of the goals. Now we get into the new products. Now, remember I told you about that current payoff amount field and how it can sometimes give you a little bit of a gotcha. I didn't enter a current payoff amount for this one. So right now, if I was to do a refinance, and I'll check refi equals yes, it automatically pulls in my remaining balance for the current mortgage as my new base loan amount. Now, if I was to continue on with this presentation right now and I had no closing costs whatsoever, this would be a zero cash to close. It's a direct payoff. I have a loan amount for $234 and I'm paying off an old loan that's $234. Now, if I do choose to use the payoff amount field, let's say that I know that by the time they take this loan out, it's probably going to be less. I can go back to my spending category here in assumptions, and I'm going to enter my current total payoff. Let's say that I know they're going to close this in a month and a half, 2 months, and their actual payoff is going to be $232.5. Now, in my refi strategy here, if I toggle this box, you can see it now pulled in my payoff amount as the new base loan amount. So you don't have to calculate. You don't have to figure it out. When you toggle this refi switch, Edge is automatically going to pull in either the current loan amount if you don't have a payoff amount field, or that payoff amount that you entered. So this will be an even refinance, and that's what you're looking for. You're looking to make sure that your new loan amount is a direct payoff of your old loan amount, and then any closing costs that you decide that you put in there can either be called for at close, or they can be financed into the new loan. So let's pop in a rate here and a term. And we're going to get to the closing cost details now. Now you can enter these as ballpark figures, just like you normally would, and that's perfectly fine. If you're just doing an estimate, that's great. There's no, I would say there's an advantage to doing the closing cost detail because you can actually itemize the fees. However, I see a lot of people just using the ballpark, so it's perfectly acceptable. Remember, this is all pre-GFE here. Everything's going to be a little bit different when you actually do put out that GFE. You're going to have solid figures on exactly what the costs are. You're going to know exactly what your client can qualify for because at that point you've run credit and you've checked against the guidelines to find out exactly what products they're going to be able to get. Now, as you can see, all we'd have to do is enter the figures in here, say $2,000 in APR costs, and I could keep going down the line. Now, on refinance transactions, oftentimes you are going to add these costs to the loan amount. That's going to increase the amount financed by the amount of this cost. So instead of my $232.5, it's going to be $234.5. It's going to be my total loan amount. That's going to cover that additional closing costs. Again, still netting me a zero cash to close if I was to do that. Now, that would happen by checking this box, add costs to the loan amount. If I don't check that box, this is going to be called for at close. So we're still going to have our regular loan amount of the $232.5, and then it's going to be $2,000 due at close. Now the other way to do this is in the detail. Now Betsy had asked before about the hazard insurance reserves. If you want to be able to use the reserve check boxes down here, you'll notice they're all grayed out right now. I can't enter a number of months. I can't check the boxes here. If you want to be able to enter these, you have to itemize. It's the only way Edge can put these back into your closing costs. It can't update your ballpark totals. So with that said, I'm going to itemize. In order to do that, click on Closing Cost Detail. And I'm just going to pull in one of my templates. Let's see, let's do the 30-year fixed refi. And you can see that there's a couple of items I might want to update. This $2,400, for instance, I could make this 1% of the loan if I really want to. And you can see that comes out to the $2,325. Now in refi transactions, remember I said oftentimes you're going to add most of them to the loan amount. There's going to be some items that you don't want to be part of the loan amount, maybe the appraisal, for instance. You want that paid outside of close. It is going to show $650 due at close here. However, understand that that's your regular paid outside of close. That's expected. The borrower is going to have to pay for that one way or another, and it usually is not going to be financed into the loan amount, though some programs do allow you to do that. Now, getting to the reserves, you notice I've got a couple of reserves lines here. These were part of my my template, but I don't need them, so I'm going to get rid of them. And what I'm going to do is I'm going to use those check boxes, and I'm going to actually have Edge funnel them back over here for me, so I don't have to do the manual calculation. So I'll hit Apply to Loan. Now you can see that Edge has grayed out the fields because these are now totals of what's inside the closing cost detail. If you need to be able to edit one of these fields that's grayed out, you'll need to go back into the detail and edit the specific line items that make up that field. So I'll put in my 15 days of prepaid interest. I am going to finance that into the loan amount. And then I'm going to go to my monthly cost screen. Now remember, we know the exact figures on these, so this was $80 and $250. And because their new loan, they're still staying below that 80% mark, they're not going to have MI on this loan. So I'm not going to enter mortgage insurance. But this is where we get to Betsy's question. If we want to use hazard insurance reserves here, what Edge does, if we take and type in a number here, type in 2 months for instance, Edge is automatically going to take this 2, multiply it by the hazard insurance right here, so it'll be $160, and it's going to pipe that back to your closing details as hazard insurance reserves. So if we go back a screen and we go into our closing cost details now, you can see that there's now a new line item in there that I didn't have to enter called hazard insurance reserves. It's automatically got the right figure in there, and you notice these are grayed out. These are calculated figures, so we can't let you change them. You have to change the variable that's calculated on. It's automatically checked the prepaid escrow box, so we're good there. It's already in the right category. So now what if I want to assess some tax reserves? And again, you'll want to consult your guidelines for what the number of months reserves are for each of these fields. Obviously no MI reserves on this one because there's no MI. But if I did want to collect 2 months of taxes, I could do that by simply typing a 2. And you don't have to hit the back arrow. I'm hitting the back arrow here just so I can show you that it does in fact populate into your closing cost detail. And you can see 2 months of taxes at $250 a month. We've got $500 in reserves here. All right, so now usually you're not going to collect 12-month premiums on refinance transactions. If this was a purchase transaction and the guidelines required that I collect an annual premium for this, I could check this box right here. And you'll see when I go back into my detail, it's going to add an additional line item. This one is going to be hazard insurance premium. And you can see that this is now 12 times that 80. So that's where we're getting the 960 there. Now if you choose to delete a line item that's been pre-calculated, like one of these guys, and then apply to loan, when I go back over to my monthly cost screen, you'll see that that checkbox is now unchecked. So they are tied together. They know they exist. So feel free to edit as you see fit. All right, so let's give this one a name, and we're going to do a specific type of transaction here. So this one I'm going to call 30 fixed rate and term. Now my next one, I'm going to add another product here. I'm going to use the copy button so I don't have to redo all my work, and I'm going to copy from this 30-year fixed rate and term and hit OK. Now remember, this 235 is what, or this 232.5 is what I have in my payoff amount field. So in the payoff amount field, if I was to put a different figure, I would have a difference between what my new loan amount is versus what my payoff is. That's going to result in either cash to close or cash out. So with that said, if I want to make this a cash out loan, so 30 fixed, cash out, all I have to do is increase my base loan amount by the amount of the cash out. And basically, let's say they want to take an additional $30,000 out of here. Now that's gonna put them into MI, but we can change this and just make this 262. Now their total loan amount, remember, is going to be this 262.5 plus any of the closing costs that you have ticked the checkbox that say add this to the loan amount. So my actual total loan amount on this one is going to be a little bit higher. Now if there were differences in the closing costs that I needed to assess for a cash out, I'd want to go in here and add whatever additional fees would be available for that. But there's not, so I'm going to go ahead and proceed through. And because I used the copy button, all this good stuff came over, which means all my reserves came over as well. So this one is pretty much done. The difference on this one is if you look over on the right here, it does show you the LTV is at 88.82. So we are going to need to assess mortgage insurance on this one. Let's say about 0.7. And this is conventional, so I'm just going to leave the 78% cutoff, and that one's good to go. Now let's take a look at how these look on the presentation. Now if we look at our new mortgages, you can see that these fields up at the top, these are the loan amount fields. So they're not the base loan amount. These are base loan amount plus all the closing costs that I financed in. So that's why these look pretty funky. And these are numbers that I didn't see inside the system because they're calculated by the time you get to the end of it. Now the cash out part, you can see I've got 28,690 cash out. And the reason for this is I have a $30,000 difference between my loan amounts, but it looks like I might not have one of the fees financed in. So let's check and see what that was. And actually, it's $1,310 worth of fees because I know my cash to close on this rate and term. There's an additional couple of items that I did not finance into the loan. Now watch what happens if we go and change our payoff amount field. This is the gotcha I was telling you about. If I don't use the payoff amount field, I'm just going to zero it out. Let's see what happens to this analysis now. So now instead of using the 232.5, it's actually using 234 as the payoff amount for my current mortgage. And you can see that that has increased my cash to close on this one. It has decreased my cash out on this one by the exact amount between 234 and 232.5. All right, so just something to watch out for when you're calculating your cash to close. We're always going to take your new base loan amount. We're going to subtract whatever your payoff amount is, whether it's completed in the payoff amount field or the current loan balance. Then we're going to take and we're going to add any closing costs that are not financed into the loan. So those will be added to the cash to close. So for instance, in this case, I have a couple of items that are not financed in. I have my reserves, which I could technically finance, and I have my appraisal. If I do choose to finance those in, and I'm going to go back and adjust my payoff amount field to be correct, that's that 232.5 that I wanted. By the time I get to my presentation, we're going to see a zero cash to close at the end here. There we go. So the reason this now is zero cash to close is I have a 232.5 payoff, I have a 232.5 base loan amount, and then I've added all of my closing costs onto that loan amount to increase the amount financed to 237,423. So that covers everything. It covers the payoff and it covers all the fees, which results in a zero cash to close. If I was to do the same thing on this cash out option, which likely you would, so I'll go in, I'm going to finance in my reserves, and I'm going to finance in that appraisal, hit apply to loan, and toggle the right arrow. When I get back to this presentation, this 28.6 is going to change to an even $30,000 cash out, because that's the difference between my payoff amount and my new base loan amount. All right, so hopefully that helps there. I know that that was a little bit lengthy on the cash to close, but it really does come across quite often to the support box. I want to make sure you're aware of all the variables that come into play in that cash to close. Now, one thing you may notice here is in our savings over 60 months, the current mortgage is showing a savings. So why would it be showing a savings? Now, what the root of the question is why is this 30 fixed cash out not showing a graph? Now, some of you who've used Edge for a while already know this, and that's that the top right and the bottom left quadrants are comparative quadrants, which means that one of the loan options is always going to be used as the benchmark for comparison. Now, in this case, on the top right one, our current mortgage has the highest monthly payment. Our new loans are being benchmarked against that current mortgage. So these are savings as opposed to the current mortgage. And when we get down to the short-term area, our short-term area is saying that our 30 fixed cash out is the highest cost loan over the 60-month period of time. But remember, you do need to know how to explain what this cost is. This is not just a difference in the pity payments over 60 months. Instead, this is a difference in the unrecoverable costs of each loan over this period. Now, when you want to calculate this out or you want to show your client what this actually equates to, you can go into the More Info section. And what we do is we take the total interest and MI paid for each one of these programs. We're going to subtract out the tax benefit for each one. And you can see the current mortgage has a pretty high tax benefit. Now, after we subtract out the tax benefit, we're going to add any closing in points. Now, the prepaid escrows are not included in the closing in points field here. These are just closing costs. Now, when we take that interest and MI, subtract out the tax benefit, and add the points, we end up with a total cost here, in this case, of $36,700. Now, you can see that our total cost between all three of these, my cash out loan is paying by far the most interest. The difference in the tax benefit is really not that great. And I've got closing costs that I've got as part of this loan. So my total cost is higher than the other two categories. That's why I'm showing a zero net savings on my 30 fixed cash out. Question from Patsy real quick. She says, how do you highlight in yellow like that? The way you do this is anytime you prepare a preview inside Edge. So when I went to my presentation screen and went to the very end, when I was first showing you guys what this presentation was going to look like, I hit the preview button right here. So select email link. You want to leave that selected at all times. I would tell you, for you new users, never select the print or PDF options. You can run into cache issues in your browser that basically whatever's showing on the screen, it's not going to match what's in print. And it doesn't happen all the time, but every now and then if you run into a network lag or something like that, you can find a disparity between those figures. So what I would tell you is every single time, choose the email link. I'm lobbying to get these disabled, by the way, because you can print and save as PDF from the live link. So choose the email link, then do a preview of that link, and that's what's going to take you to the live version. When you're on a preview, you can hover over any field and left-click on it, and it'll highlight. And whatever state you leave this presentation in is what your borrower is going to see when they click on your link. Now remember, you click the preview button to get here. Your borrower, in order to get to this report, will click on the link that you send them. So I'm going to open up a second tab here, and I'll show you this is what happens if the borrower clicks on your link. They see the disclaimer, they see all your highlighting, but they can't do anything with it. They can't deselect it or drop new highlighting on it. I mean, they can select it with their cursor, but that doesn't do anything. Only you can control the highlighting. It can only be controlled from a preview or from Edge Live. And some of you may not be aware of what Edge Live does. I would encourage you, actually yesterday, I did a call on our success strategies. And if you go to our coaching call archive, which by the way, you can get here by clicking help inside Edge and then clicking on this link here, it says click here to access our coaching call archive. This is every single call we've done over the last couple of years. They're all cataloged. You can even search through these by simply hitting Control and F on your keyboard. That's going to open up a little search box up at the top right. So for instance, if I wanted to search for success strategies, I would type in success, and you can see I've got 19 entries that match that. And if I look on my page here, it's highlighted every single one of those entries. So now I've, within a couple of seconds, isolated every single one of the success strategies calls that we have in here. Now the one we did yesterday was called 5 Things You May Not Be Using in Edge. And this covered things like the analysis copy features. You know, how do you add a new analysis, or if you're doing multiple properties for a single realtor? You want them to be grouped together. You don't want to have to do you don't want to have to do individual records that are duplicates of other records in your system. So you want to pile them into one. How to use Edge Live. I covered that in detail on yesterday's call, so I would encourage you, when you get a chance, this is only a 30-minute session we did yesterday, but check it out. It goes over Edge Live in full detail. I also went over creating full product templates, start to finish product templates, so that you only have to do a click or two of data entry to enter a total loan product into Edge. I then showed customizing reinvestment strategies for things like reinvesting MI after it drops off or doing lump sum payments. And then the final thing I showed on yesterday's call was the Edge widget. And if you haven't seen the Edge widget, it's just a simple and clean way to get a contact form out to your borrowers and partners. And when people submit through this form that you create, it automatically pipes that in as a client record inside Edge. So you'll have not only their contact information, but you'll have a record started. So you can just immediately jump in and start creating that total cost for them. So if you guys want more detail on those things, check out this call. I think you're going to find it very valuable. Not to toot my own horn here, but, you know, I'm good. But hopefully I got a couple of you to laugh today. But anyhow, let's get back to our presentation, and we'll check out what we've got going on inside Edge. So the question was, how do I highlight? And there's two options here in terms of how you're going to do the highlighting. And one of them is hitting the preview button here. The other one is using Edge Live. And you would do that by generating your link. And Edge Live is meant to be used on the phone with the borrower. So when you send your borrower this link here and they click on it, get them on the phone. And what happens is you hit Edge Live, and whatever you do here in Edge Live is going to be immediate on their side. So let me give you a little preview of how that looks. Reduce my windows just a tad here. And want to break this one out so we have two different screens. Let's make sure that this is, okay, good. So this is the borrower's version here on the right. On the left, what I've done is I sent my borrower my link. He clicked on it. That's how he got this screen right here. Then I went into Edge and hit Edge Live. This opened up a new tab for me. The difference between my version and my borrower's version, I have the ability to highlight. The borrower does not. I also have the ability to clear out all the highlights. So if I hit Clear All, look what happened on the right side. So what this is meant to do is this is meant to give you an interactive session with your borrower. You've sent them the link. You've gotten them on the phone. You know they've clicked the link, and you're talking to them about what this presentation is. And while you can't see exactly what they're looking at, you can highlight things and know that it's going to pop out highlighted on their side. So if I'm having this conversation with my borrower and I'm showing, hey, your rate and term option is a 0 cash to close. So I highlight the 0 right there. It automatically highlights on my borrower's side. Then I'm going to talk about the cash out option. I'm going to highlight that 30 grand, and it automatically highlights over there on the borrower's side. Furthermore, if you want to pop into the more info sections, say for instance, I wanted to show them the payment breakdown. When I do that on my side, it pops out on their side. If I was to bounce a graph by left clicking on it, it does the same thing on their side. So you can see this is a very easy way to drive your client through the presentation and point out individual elements that you know that they need to be made aware of. So you can see if I was having the MI conversation, I'd highlight those MI fields, and it'll highlight on my borrower side as well. Now when you close one of these more info sections, it'll close on your borrower side. So you can do that for each one of these more infos. You can do it for the payment streams. You can do it for the closing costs. So for instance, if I go into more info and go into my closing costs and then click on fee detail, you can see that it pops out everything for me. If I wanted to highlight a specific fee, it does that on my borrower's side as well. All right, so that's just a brief glimpse into how to use Edge Live, but I would encourage you, watch the presentation we did yesterday. You'll get a little bit more detail on how this works and how you can use it for your business. All right, so question from Michael Fournette. I'm sorry, Michael, if I mispronounced your last name there. Question was, is there a rent versus buy option? So yes, there is, and in order to trigger that, what you do is in the first screen of any client presentation, click on the rent button. And when you do that, Edge is going to ask you questions relative to a rent versus own. So when I hit my right arrow, it's going to ask me, what are my goals here? Well, I want to get my first home. Then it's going to ask you about their rent. How much are they paying right now? Well, they're paying $2,200, and it's got an annual rent increase of 3%. And, you know, they have monthly rental insurance of $15. If there was other monthly rental expense, you could put that in there as well. Now the standard deduction field, I do want to go over this with you because it's very important. When you are doing a rent versus own, you have the option of showing what's called a tax benefit analysis between the two options. Now on the rent side, the only tax benefit they get is the standard deduction. That's all they get. So if you enter their standard deduction in here, you are going to see a tax benefit on the rent side. It's going to be minor, but you'll see one. Now I'll show you what it looks like. Now, if you don't know your standard deduction for your client, you can hit Find Standard Deduction. This takes you to an IRS site. It's going to be 3 to 5 minutes. It'll ask you a bunch of questions about their filing status and such, basic income. And then at the end, it's going to spit out a number for you that is, in fact, their standard deduction. So once you find that, and for a single, it's about $6,100 right now. Once you find that, enter it here. You will show a tax benefit on the rent side. Now again, you have to have a tax bracket to show a benefit at all. So that standard deduction, the way it's been calculated is we ask you to input the standard deduction per year. Then we take that, we multiply it by 0.28, their tax bracket, and then we divide that over 12 months to find out what their monthly benefit would be if they just continued renting and took the standard deduction. Now obviously on the home ownership side, the home ownership side is going to have a greater deduction because they can write off the interest that they're paying every year, and they can write off their property taxes. So on those cases, you're usually going to have a greater benefit on the home ownership side. So now I got to make this a purchase. So remember, these were all rate and terms. So when I made this a rent versus own, it automatically got rid of my current mortgage for me, so I don't have to worry about that. I'm just going to make this a purchase. And the easy way to do it, let's say I'm doing an FHA 3.5% down, pop that in there, and I'm just going to change my title. And you notice I used a product template. The whole reason I did this is because this has everything in it. This has my loan parameters, it has my closing costs, it even has my upfront MIP already set up. If I was to go into my details, you'll see that it has everything all the way down to the reserves. And if I needed to add anything, let's say I needed to collect additional reserves or collect an additional premium, I could put that in there. But it funneled the whole thing in there for me. So I really did 0 keystrokes to make this 30-year FHA happen. Now for my next one, I'm going to do a conventional. So we'll call it 30 fixed conventional, or maybe I'll just call it 5% down. Now what I can do is I can copy from the original one that I did, and that's fine. We just use copy from, choose the FHA, and then basically what I'm going to do is I'm going to deselect the FHA category so it removes the upfront MIP. But another way to do this is get your templates developed. I've got a 5% down conventional template. Once I apply that, you can see it's automatically put in my down payment percentage. It put in the rate that I specified in my template. And as I go forward, it's got all my costs in there. It's even got contributions that I set up because I'm having owner's title paid by the seller. And it's got my monthly costs. So you can see that I've got a lower MI factor here. My reserves are slightly different. And I'm good to go. I really didn't have to do any data entry on either one of these products to get 2 products against each other versus the rent. So now we get into this lower left quadrant here. Remember I told you about the standard deduction. Now you have the option of choosing rent versus tax benefit. Now this is just comparing total rent over 60 months versus total tax benefit over 60 months. If you choose tax benefit analysis, this shows you the different tax benefit between the options. So for instance, on the rent side, over a 5-year period of time, just taking the standard deduction, they will have a tax benefit of $85.40. On the home ownership side, over the 5 years, because they can write off all the interest and they can write off all the property taxes, the benefit is much greater. So it's up to you in terms of how you want to show this. You know, there's 2 schools of thought on it. Is that, you know, if I'm renting, I don't get any benefit, which is perfectly fine. Remove the standard deduction and you're good to go. But the other school of thought is, well, you know, I am going to get my standard deduction every year. So if I'm really going to look at what kind of tax benefit I have in one equation versus another, I kind of want to try and make them as apples to apples as possible. And this would be the way to do it. Get that standard deduction in there and compare it against the new tax benefit on the home ownership side. Now, one thing I will qualify for you right now is that anytime you show a tax benefit on a presentation, please disclaim yourselves. Unless you are a CPA or a financial planner or a tax attorney, disclaim yourselves. Just let them know that these are estimates. They should consult their CPA or tax advisor for additional details. You don't know their exact filing status. You don't know how many kids they're writing off somewhere. There's a bunch of other factors that can come into play that you don't want to be called on the carpet for. So always disclaim yourself anytime you're showing a tax benefit. All right, so that was rent versus own. And hopefully, Michael, that answers your question there. As you continue going through these screens, you'll get to where you can prepare a link for the rent versus own. And if I was to continue on, it's going to give me a link that's going to point directly to the presentation I just prepared. Now, the other question in the box right now is from Betsy. She says, can you please re-explain the savings over 60 months? So as you noticed here in the rent versus own, it's not the same kind of savings as we looked at the total cost analysis. So what I'm going to do is when I go to my presentation, I'm going to select the total cost. Now, one thing to keep in mind is if I had selected rent versus own, continue on, generate the link, and then come back and select total cost, continue on, generate the link, they're going to be 2 separate links. And it's okay. You can do that. It's perfectly acceptable in here. Just realize that both links are going to be pointing to the data that you have here in your products. So if you were to change one of your products, it's going to change it for both the rent versus own and the total cost that you developed. So let's get through these screens here. And, oh, I do want to show you this. As a matter of fact, I'm going to paste this into our chat box here. I have this set as my default verbiage for my short-term savings because this is the one that Betsy was asking about. You know, how is this really generated? What are we looking at? When you go into your settings, you can set up defaults. So for report templates, you can see that in my short-term area on the total cost analysis, I've got that default verbiage in there. You guys probably only have this. So I would encourage you, fill this out a little bit as a default so you don't have to do it every single time. But let me put this in the chat box for you as well so you can, you guys can use it as needed. All right, so that just got chatted out to everybody. Feel free to copy and paste that into your settings if you'd like. There is an additional variable that comes into play, and that's if you are showing the tax benefit, it is part of this equation as well. So let's go back into our purchase option that we were just looking at. And let's see, did I put in a tax bracket? I sure did. So I'm going to go back to that short-term area. And the one part that has changed about this is the total costs include interest, MI, and closing costs less the tax benefit. And when compared against each other, the graphs shown display the difference. So if you're not showing tax benefit, you don't need to include this little verbiage right here. If you are showing tax benefit, make sure to include this. Now, let's go over what that actually looks like on the presentation, just to make sure we've got a solid understanding of what that short-term area looks like. Now, if we look at our savings over 60 months, we have our 30-year FHA, which is being used as the benchmark. This is the highest cost of the programs. And the reason is that cost is determined by taking the interest in MI, subtracting out the tax benefit, and adding any closing costs and points. So our total unrecoverable costs are $70,115. Now the reason we don't include principal in this equation is they're retaining principal in the form of equity. So they still have this. This is a recoverable cost. If they chose to refinance, they could get that cost back. Whereas interest, MI, closing costs, those are the ones they can't get back. Now they do get a tax benefit on the interest. And not this year, but previously they could get a tax benefit on the mortgage insurance. The tax benefit, the reason we show it here is because that's the recoverable part of the interest. So we're taking interest in MI paid, we subtract out what they can get back, and then we add in closing and points because they're not going to be able to write those off. And actually points they could potentially write off. But our total cost then becomes $70,115. Now I will tell you that for the tax benefit equation, the points are included in tax benefit, so we eyeball that for you and we automatically calculate it into the tax benefit line right here. So you can be confident in knowing that this equation is interest in MI minus the total tax benefit for anything that's deductible plus the closing costs and points that they're paying out of pocket. That gives us, and not only out of pocket, I'm sorry, I misspoke. That's closing costs and points that they're paying. Whether they're out of pocket or financed into the loan, they're going to be included right here. The total cost then is the total of these figures. Interest in MI minus tax benefit plus closing costs. That's where we get our totals. When these totals are compared against each other, that's how we find out what our net savings is over that 60-month period of time. Now you can see why it becomes important to really put some additional verbiage around what this means. When they click the More Info button on your presentation, this should really tell them what you're trying to get across with your short-term savings. And the same thing goes for the long-term. Feel free to put additional verbiage in there that you think could benefit your client. They're going to see this. When they click on these, it's going to show up right next to this this graphic. So, as a client, and in fact, most originators do not understand this equation until it's shown to them. And the whole premise behind the way we do this is, we started with the total cost analysis back in 1997. It was based on a Microsoft Access program, and we were just looking to isolate just the cost of the loan that really mattered the most to a borrower when they're shopping between loans. And we found that, principal, it's kind of a wash. If they take two loans for the exact same loan amount, they're going to pay the exact same amount of principal over time. It's a wash. So what are the real differences between the loan products? Well, the real differences are the interest, MI, and the closing costs. And of course, the benefit comes into play because these particular programs will have varying interest rates, so they'll have different amounts of interest that they're going to pay. So they will have varying amount of tax benefit. So we recently, this is fairly new that we threw the tax benefit into this equation, but our equation since 97 has always been interest in MI and closing costs are the primary factors in making your loan decision. All right, so Betsy, let me know if you need a little bit more on that one. Hopefully that gives it to you right there. Now, long-term section, we've only got 5 minutes left here, so I just want to kind of cover the quadrants for you just so you're aware of where everything is for when you're presenting this to your client. If I'm presenting this to a client, I'm starting at the top left, and I'm going to start off with the summary. And realistically, I'm going to highlight the items that I want them to see, or I'm going to do Edge Live for them so they can actually see the highlights flicker on as I do them. But the items that I'm going to point out for them are the items that everybody else is showing them. So I'm going to start with, look, I'm showing you 2 different loan options. I know everybody's showing you a couple of different loan options. You know, if they're shopping you out, they've seen GFEs and scratch pad sheets from other people. But the reality is what they're seeing from those other people is just a rate and a payment. So you might want to start there. Here's your rates. I'm going to deselect this stuff. And here's your payments. This is what they're quoting you. Now, can you tell by just looking at these which one is more beneficial? Yeah, I can see a monthly cost savings on this 5% down, but I also know I have to bring in more cash to close. All right, so to me as a consumer, I don't see a whole lot of difference in this. I'm looking now at monthly cash flow being my primary decision-making factor, which, you know, in this case it actually happens to work out, but in a lot of cases it doesn't. If you're comparing a 30-year loan versus a 15-year loan, that 15-year loan is going to have a much higher payment. Cash flow is going to be a little bit harder to do for your client, but the savings, the interest savings over time are phenomenal. If you cut an amortization in half and you don't have to pay half the interest that you otherwise would have paid, that's a huge savings. Even on a small loan, you're going to have an exorbitant amount of interest savings just by showing those 2 against each other. So I'd start with this. I'd start with showing him what my competitor is showing him. We're seeing a rate, a payment, and a cash to close. Then I'm going to dive into detail. I'm going to say, Mr. Borrower, there's a difference. There's a couple other factors that come into play here. These are your tax benefits between each program. You notice they're about the same between each one. So what I'm going to tell you right now is that the tax benefit, at least in the monthly, is not going to be an immediate decision-making factor. Now, when we do get to the more info, I'm going to point out tax benefit again because I want to show them what it does in the long term. Most consumers don't understand that mortgages aren't simple interest. It isn't half of your payment goes to principal, half of it goes to interest. It's a sliding scale of how much interest you pay. And in fact, if you were to ask most consumers, on which payment do you pay the most interest in a 30-year term, they wouldn't know. They wouldn't know. But you all know it's the first payment. That's the one that has the most interest that you're going to pay for the life of the loan. And then it's going to keep declining over time. And eventually, you know, on a 30-year mortgage, you're going to hit that breaking point right around 13 years where you have tilted the scale to where they're paying a little bit more principal than interest. So obviously, the last half of a mortgage, they're paying the most principal. But the idea behind this is if the first part, if you know the first part is where they're going to pay the most interest, show them this 60-month period of time. This is the most painful part of the mortgage. Maybe even show them a 10-year period of time. This is where you're going to pay the most interest. So let's look at these 2 loans against each other and figure out which one's going to be best for you. Now, it also depends on what your particular theory is on how long should a person stay in a mortgage. You know, obviously, everybody has different ideas about it. There's lots of schools of thought. You know, there's the Dave Ramsey school of thought, which is, you know, paid off as fast as possible. You know, there's like what Rick Edelman showed on the coaching call the other day, and that's that, you know, make your mortgage work for you instead of, you know, keeping it in cash. You know, you can actually profit off your mortgage instead of leaving it in risky funds. So it depends on what your school of thought is on this in terms of how you want to present this to your client. But when we're looking at most transactions today, and especially right now, rates have gone up a little bit. They're not as low as they were, you know, last year, maybe a year and a half ago. But rates are always going to change. So the real thing that comes into play is if you're looking at fixed mortgages, obviously the lowest rate is going to be the best thing you can do, assuming you don't have to pay too many points to get it. But we want to make sure we isolate exactly what those costs are. So once I've finished showing my client just the summary section, I've shown them just the top level indicators on what each mortgage contains. I'm going to jump into the more info section. And I'm going to show them the payment breakdown between each of these. I'm going to show them that, you know, on the FHA loan, you're paying a lot more mortgage insurance on month 1. But that also leads into the conversation of what happens to this MI over time. And that allows you to educate the consumer on really FHA loans have this huge stigma around carrying MI for the life of the loan. What most people don't realize, though, is that it declines. It declines based on the balance. So by the time you get to the end of this loan, you've only got about a $30 mortgage insurance payment. This $324 has almost dissolved. So when we're looking at these against each other, we really do need to look at the long-term effects. So I'm going to point out those figures. I'm going to have that conversation with my borrower. I'm going to point out the total pity payment again. Now when we look at the graphs, you can see that the graphs are broken up between payment and escrows. The escrows are going to be the same between these two mortgages. But this green part and yellow part, those are actually your payment. That's your P&I. I'm then going to dive into my closing costs. And I'm going to explain to my client that these are the totals. So I'm highlight the whole field. And then I'm going to drill them into the fee details. So I go into the fee detail and I'm going to show them these are all the fees that are going to be assessed. These might be slightly different at close because we don't know exactly when you're going to close. There might be a couple of differences in these dollar amounts that I'm using versus what my system is going to come out for you. But overall, this is what you can expect to see for your fee structure. Now I can guarantee you that unless your competitors are giving your client a GFE, they are not showing them this. They are giving them a ballpark every single time. Well, it's going to cost you about $4,500 to close. Okay, well, how do you arrive at that figure, Mr. Originator? If I'm a consumer and I don't see the transparency of how these calculations are arrived at, I'm going to start asking a lot more questions. So what this gives you as an originator who uses the EDGE program is this gives you that additional transparency without having to really do much to get it. So now you're positioning yourselves as, okay, look at what I'm going to do for you. I've showed you what my competitors do. They're going to give you a rate, they're going to give you a payment, and they're going to give you a cash to close. But I'm going to drill it down to the minute details. I'm going to show you that each one of these loans has a lot of things that my competitors aren't telling you about. They might not even be talking about MI with you. I want to talk to you about MI. I want to tell you what it is and how it functions in each one of these products. So after you finish showing them the fee detail, you're going to jump back to the payment stream because this is what really spells it out for the MI. And I'm going to start with the conventional. On the conventional, I have 113 payments, and this is my P&I and MI payment. You can see my rate stays the same because this is a fixed loan. After 113, my mortgage insurance drops off. At this point, I've now got 246 payments at a lower amount. So no MI here, I go to 1468. Then I have a true and final payment. This is just basically enough to pay off the rest of the mortgage, and it's roughly the same as the rest of the payments, but it's going to be slightly different. Now most people expect to see something like this, and if I had no MI, there'd only be two line items here. But what most people don't expect to see is check out the payment stream on the FHA program. This adjusts every 12 months, and it's not the rate adjusting, it's not the payment adjusting, it's the MI adjusting. The MI is declining based on the average 12 months balance every single year. So you can see what my ending balance is doing going down the line. This is what's determining my MI dropping. And when I get to the very end of this, my total payment here, $1,507.72. And if we look at just what the P&I payment is, $1,495. Now remember I said my P&I and MI was $1,507? That's only $20 of MI at the end of the loan program. So keep this in mind. This is a major chance for you to educate your consumers on exactly how these loan products work. Now after you've gone through that initial section, you're going to tell them, hey, if you want us to just see those details for each loan program against each other, these are the cursory elements. They're up here on the top right. You can click the More Info section. This is also where it shows what I use for your property appreciation and what I use for your tax bracket. Then at that point, I'm going to spend probably the most time going over the savings in 60 months. I really want to drill home the point that these are just the unrecoverable costs of each loan. I want to tell them where we're getting all these costs. I want to tell them how we're getting the tax benefit. I want to show them how we're getting this comparison and why this $14,000 is not just the monthly savings multiplied by 60. I'm then going to go to my long-term section, and the long-term is different from this top right and bottom left quadrant in one respect. It's not a comparative module like the other ones are. You're always going to find that both products have a graph. There's no benchmark on this one. So all we're looking at is at totals for each one of these products. And it spells it out pretty clearly. Interest in MI over the 15-year point for the FHA program, 224, versus conventional at 187. So definitely a marked difference between the two of them. And obviously this is the MI carrying longer out. And it's really a function of the MI at this point. But let's take a look at the 30-year point. So I'll jump back over into EDGE, go to my analysis screen, And I'm going to adjust out my, my long-term years to 30. And actually, I'm going to do it in the presentation area, and I'll show you why. Remember I said if you choose rent, the analysis screen is always going to reflect the rent versus own. So if you want to make changes to the parameters on a total cost report, come in right here and do it. And then when you go over to your presentation, this is going to adjust to 30 years. And now we can see that between the FHA and the conventional, we've got $70,000, roughly, about $60,000 of interest in MI savings on this conventional loan. Now when we look at our cash to close, which is what our competitor was talking about, there's only a $5,000 difference in the cash to close. So $5,000 investment to gain $60,000, I'd say that's pretty easy. Now, again, goes back to your strategy. Are they going to stay in the mortgage for 30 years? Probably not. But if they did, this would be the result. And if they're not going to, you can position reinvestments. You can position a refi strategy at a 5-year point. And in fact, you can start talking about ARMs there, because now you keep them in the fixed period and refi out as soon as they start adjusting. But there's lots of factors that can come into play there. I wanted to show you the overall look at these loan products. If you stick with them, and if you stay in the house, if we assume that right now these great rates are not going to get any better in the future, because it's very possible, if you have to stick with your loan, you're going to have the best option here, and I've shown you in 4 different ways now that this conventional 5% is your best option. All right, so I know we're a little bit over time today. Thanks for sticking around. I really do appreciate it. We did record this event, so this is going to be posted to our coaching call archive. And remember, that one you can get to by clicking on Help in your Edge. And then once you get to our knowledge base here, just click on the link at the top that says click here to access our coaching call archive. That's going to take you directly over to all the calls. And then this one will be posted right here at the bottom of June. So you'll see today's date and then Thursday training call. And I will describe what we covered today. But with that said, if you guys have any further questions, please do contact us, support@mortgagecoach.com. You can also submit a ticket here through the knowledge base. So when you click Help, you'll see an icon up at the top that allows you to submit a request. That'll immediately file an email over to our ticketing system, and either I or my crew will get on it right away and get your response as soon as possible. But again, thanks for joining us today. Hope to see you all next week. Take care and get out there and make some money. Thanks, guys. Bye-bye.